Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about trend trading for beginners. And if you've been a regular viewer or a regular attendee of this ITU Forex classes, then I'm pretty sure you must have heard me talk about trend trading a ton of times. And this is simply because trend trading holds a special place in my heart because it's the method which I actually used to become a consistently profitable trader. Because at first, when I was still struggling to find a way to trade the markets profitably, I tried lots of methods. But then eventually, as God will have it, I stumbled upon trend trading, even though at that time I didn't quite know that it was trend trading. And everything just clicked because it was it was the way that I found that was easy for me to actually squeeze profits out of the markets without pulling my hair out and all of that stress that comes with trading. Okay, so again, the reason we're talking about this particular topic today is because trend trading is one of the easiest ways you're going to find, which is going to help you to become a consistently profitable trader. And this does not mean that when you just learn how to trade with the trend, when you dump everything out the window, the other essentials, I'm talking about risk management and having the right mindset and psychology and all of that, that you're going to be profitable. Of course, no. Trend trading is just a technical technique that will help you to identify low risk, high probability trading opportunities. But in and of itself, it's not going to make you profitable. You'll have to couple that with proper risk management and having the right mindset. And then when you put all these things together and then couple it with trend trading, which is kind of like the technicals, which is going to tell you when and where to buy or why and where to exit or enter into a trade and take your profits and all of that, then you're going to have a genuine edge in the markets. Okay, so without wasting any more of your precious time, let's dive right into it. Okay, so first things first, what exactly is trend trading? Because you must have heard me, like I told you, if you've been a regular of these classes, you must have heard me talk about trend trading quite a lot of times. But for those who are complete beginners, and since this is the title of the topic, obviously, of this week's class, trend trading for beginners, then for those who are complete beginners, then you might not know what trend trading is. So let me give you a quick example, okay? You see, when price moves in the market, it usually does one of three things. Okay, so it's either going to be moving in the direction of a trend, and we'll talk about what a trend is, but I need you to first understand the three phases of price movements in the market. Okay, so it's either going to move in the direction of a trend, or it's going to be ranging, which simply means it's going to be bouncing off of levels of horizontal support and resistance most of the times. Okay, and then the third thing is price could either be consolidating. Now, when we talk about these three things, let's break them down into more components which are going to be easy for you to understand. Okay, so if price is trending, it's either going to be trending either to the upside, which is when you're going to be hearing traders talking about uptrending markets, or it's going to be trending to the downside. Now, when we say price is trending to the upside, what we simply mean is that over a given period of time, regardless of how long the time is, it could be, the time frame might just be a day or a week or a couple of hours or minutes or whatever the case might be. Okay, it's just over a given period of time, price is consistently moving in one direction. That's simply what a trend is. What a trend means. Okay, so if price, for example, this is the GBP JPY currency pair. So if the price of the GBP JPY currency pair over, let's say, a trading session, a 24-hour trading period, for example, okay, if it moves from all the way down here, which is at this moment in time, for this particular example, around 210 Japanese yen for one British pound. So if it moves from all the way down here and it goes all the way up here within that trading session, which is 215, you need to pay 215 Japanese yen to buy one British pound, then we would say that price has risen, it has gone up. Okay, but then for it to be a trend in the sense of the word, in the real sense of the word, then it has to move in a specific manner. And this is how trends actually form in the financial markets. Even if an instrument is strongly trending in one direction, when I say one direction, meaning when the price of an instrument is moving in maybe to the upside or to the downside, it's predominantly moving in one direction. What you would find in the financial markets is that that movement is not going to be in a straight line. For example, even when there was this mania of Bitcoin and, it was going up and whatever the case might be, it was moving from way down here when people were just making a killing with Bitcoin. Even though it was trending, it didn't move up in a straight line. And that's because that's not how price of instruments or tradable instrument, financial instruments usually move in the markets. What you're usually going to find is price is going to go up a bit and then it's going to rest a little bit. It's going to make a pullback. It's going to make a correction. Okay? You would hear traders calling this resting phase a lot of different names. You would hear some traders calling it correction. Some traders will call it retracement. Some traders will call it what do you call it? There's the move in the direction of the trend is the impulse wave, and then the move in the opposite direction of the trend is called the corrective wave. Okay, so there are different names for it, but long story short, when price of an instrument moves in the financial market, even when it's trending, is not going to move up or down in a straight line. If it's an uptrend, it's usually going to move by forming highs. For example, let's say this is the low, then it will form a high, and then it will form a higher low. Usually, this is what you'd find. This is how the price of an instrument which is trending to the upside in the financial markets is usually going to move. So it's going to move from a low point to a high point, and then it's going to pull back. If that trend is really a strong uptrend, a healthy, strong uptrend, then it's going to make a pullback, which is not going to be as deep as the origin point where that move started from. And so because of that, it's going to lead to the formation of a higher low. And then eventually, price is going to move higher by breaking above the previous resistance level where it failed to break above. If this truly is a trending market, uptrending market in this example, then price is going to continue making this type of move. It's going to form a high and a low and a higher low and a higher high, higher low, higher high, higher low, and higher high. So as long as this uptrend remains intact, price is going to continue moving in this direction with this manner, in this typical fashion. Okay, but then because how do you say it? All good things come to an end, and some traders even like to coin a term that a phrase that they call it like the trend is your friend until the bend at the end. Okay, and this is simply just kind of making you realize that no matter how good a trend is or no matter how strong a trend is, it's usually not going to last forever. So there's going to come a point in time where that trend is going to either reverse or temporarily stall or consolidate before continuing in the predominant direction or whatever, or maybe doing a reversal in the market. So when that happens, then price is going to struggle to continue forming higher highs and higher lows. And then out of the blue, price is now going to struggle to break above the previous high. Because if the trend is healthy, then it should continue forming higher highs and higher lows. But if it's starting to weaken, that means the bulls are not strong enough to continue pushing prices up. Then what you're usually going to see is price struggling to break above the resistance area which it formed previously. Okay, and then the higher lows are now going to start getting penetrated or even getting broken to the downside. And then all of a sudden, price will move from forming higher highs and higher lows to, more often than not, forming lower lows and lower highs. So we've moved from the market structure of price forming higher highs and higher lows, which is the typical market structure of an uptrending market, to the market structure of a downtrending market, which is how do you call it? Which is depicted by price forming lower lows and lower highs, lower lows and lower highs. Okay, this is a textbook example of what a uptrending market and a downtrending market looks like. Okay, so why did I say I found profitability when I started trend trading? Because it's one of the easiest way to trade and make profits. The reason is because, think about it. What do we do typically as Forex traders? What do we need to do to be able to squeeze profits out of the market? What do we need to do? If your answer was, we need to buy an instrument when it's cheap, and then we need that instrument to move up in our direction, okay, for us to be able to make a profit from that trade and close that trade, then you're right. Because whatever the case might be, whatever strategy you use, whatever trading methodology you use, there's one thing we want price to do. And that's simply, we want, whenever we buy a trading instrument, for example, or whenever we go long, we want that instrument to go higher than the price where we got long at, or where we bought that instrument at, for us to be able to make a profit from that trading position. And if we were to sell or short a trading instrument, for us to be able to make profits from that particular trading position, then we need the price of that instrument, to go lower than the price where we shorted it at. And when we're talking about trending markets or trend trading, usually what you're going to find is that I told you the typical anatomy of the movement of an uptrending market and a downtrending market. For a downtrending market, price is going to usually be forming lower lows and lower highs, lower lows and lower highs, lower lows and lower highs. Now, one of the characteristics of a downtrending market is that whenever it's forming this higher lower lows and lower highs, there's going to be, like I told you earlier on, there's going to be a pullback, a retracement, or a correction. So whenever we see price moving making the market structure or movement of the market structure of a downtrending market, which is characterized by the formation of lower lows and lower highs, lower lows and lower highs, automatically, when we get a break below the low, the most recent low, we will be anticipating that price is likely going to form a lower high. And so we would be looking that, okay, if this is truly a good trending market environment, then price should have no business whatsoever, after it breaks below the low to form a lower low, it should have no business whatsoever to form a higher low. And so if this is truly an downtrending market, then whenever we see a pullback around this area, and then we start seeing rejection candlesticks like a bearish engulfing candlestick or a doji or whatever the case might be in a downtrending market condition, then we assume that the trend is likely going to continue to the downside, and so we'll short that currency pair and then anticipate that it's going to go down so that we'll make a profit from the trade. Now, using this particular chart as an example, this is the 1 hour time frame of the currency, the GBP JPY currency pair. Now, if you take a close look at it, you'll notice that price for this particular currency pair at some point was moving to the upside. So when I pick this tool here, you'd notice that price was making the market structure of an uptrending market. Okay, so it was making higher highs and higher lows. Okay, higher highs, and this was a higher low. So ideally, if this truly was a strong uptrending market, what we would have wanted to see was price breaking above this resistance area and then continuing to move to the upside. But price failed to do that. On the contrary, price tried to go up, but it couldn't even reach the previous high to test the previous high. And then this higher low, out of the blue, price just came and broke below it. And now, when price broke below this higher low, let me quickly pick this tool and place it here. This higher low, when price broke below it, you can see that it went down. And so it tried again to test this area as if it wanted to continue moving up, but the strength, the rejection from the bears, the sellers, the short sellers, was just so strong in the market that it couldn't even retest this previous high level. And at this point, we went from forming the market structure movement of an uptrending market to the market structure movement of a downtrending market, which is we went from forming higher highs and higher lows, higher highs, higher lows, higher highs and higher lows, to now forming lower lows, okay, and lower highs. Because this, obviously, this is a equal highs, but then this high is higher than this previous high, this most recent high, okay? And so now we've moved from forming the market structure of an uptrending market to now forming the market structure of a downtrending market, which is characterized by this lower lows and lower highs. So out of the blue, when this market structure got formed, we now know that we've shifted from a uptrending market to now a downtrending market. Now, here's my question to you. If you know that this is a downtrending market, what is usually the two methods that traders use to find trade entries, low risk, high probability trade entry opportunities in the direction of the trend in the market? Usually it's one of two things. It's either a trader is a pullback trader, which simply means that when price is forming that higher high and higher low, or in the case of a downtrending market, lower lows and lower highs, that trader is going to be waiting for when price is going to pull back or make this retracement or correction, and then he's going to be looking for short trading opportunities to join in on that trend, so that when it's going to make its next leg down, he's going to take a trade in the direction of that trend and then try to capitalize on this. Okay, and then there are other traders who are also trend traders, but they are not pullback traders. They are breakout traders. So instead of them waiting for a pullback and then taking a trade in the direction of the trend, they're actually going to wait for price to break below the level where it failed to break below previously in the case of a downtrending market to join in on the trend. They are waiting for a breakout instead of a pullback. Both of these methods are valid, and they all depend on which one you're most comfortable with. You could use both, obviously, but some traders resonate more with waiting for pullbacks, while other traders prefer to wait for breakouts. Okay, my style of trend trading usually involves breakout trading. Okay, waiting for price to break out in the direction of the trend before I join in on the trend to catch the move. Okay, so moving on, you can see the example we have here is price went from an uptrending market to now a downtrending market. Now, here's what I want you to notice. You see, this was previous lower high, higher low. Okay, let me quickly do this. You can see that price went from forming higher highs and higher lows, and then now we're forming lower lows, okay, and lower highs. This is a low, okay, this is a lower high, this is a lower low, okay, and this again equal lows, equal highs, and but this high is also lower than this low, so you could even call it a higher low. In this case, you can see that this was our previous breakout level, and then price broke above this level and formed a lower high. This also qualifies as a lower high here, this level, as a lower low, this area, okay? And you can see that when price broke below this area, it retested it, and then there was the formation of this big bearish engulfing candlestick. Now, if you are a pullback trader, you would have waited for price to form this, and you could have easily taken this short trading position when price closed below this area with this big bearish engulfing candlestick. And your stop loss, if you were trading with a conservative stop loss, meaning it was a little bit higher than the previous lower high, then your stop loss would have been somewhere here. And if you're trading with a 1:2 or 1:, whatever risk to reward ratio, this would have been obviously a clean winning trade, because we've shifted from an uptrending market to a downtrending market, and we've started forming lower lows and lower highs. And now, if you're using the pullback trading technique, the breakout trading technique, this would have been a good entry for you that you would have caught this move with. Okay, looking for another example again, you could see that price is obviously forming the market structure of a downtrending market. So it's forming lows, lower high, lower low, and lower high. Now, when I pick this tool, and you could see this is the lower low before this area, but you can see that when price broke this area, using the pullback trading technique, you would have waited for price to pull back, make this retracement. Obviously, it did. Break and retest traders will tell you that when price breaks, when a level acts as support and then price breaks that level, when price retraces to that level, it's going to serve as resistance. And that's exactly what we saw here. Price was acting as, this level was acting as support, but then when price broke below this level and it retested it, you can see this level acted as resistance. And then there was a liquidity sweep around here, and then there was the formation of this bearish engulfing candlestick. Now, if you are a pullback breakout trader, if you're a pullback trend trader, this would have been a very good short trading opportunity, because this was a clear bearish engulfing candlestick. So if you are trading with a conservative stop loss, you would have wanted to place your stop loss above the previous the lower high, which would have been somewhere around here. Obviously, This trade, if you're using the conservative stop loss approach and you're aiming for, let's say, a 1:2 risk to reward ratio, for example, this would have been a losing trade. Nothing wrong with having, let me see, would it have even been, yes, it would have been a losing trade. Nothing wrong with having a losing trade because, again, I don't want you to have the illusion that every single trade you take using this technique or any other technique we teach you on this channel, that is going to be a winning trade, because that's not the reality of trading. The reality of trading is that whatever technique you use to trade, you're usually going to find winning trades as well as you're going to find losing trades. But the defining factor is when you properly manage your risk on each and every trade you take, having the right mindset, then eventually the profits from your winning trades are going to outclass or outperform the losses that you're going to have from your losing trades. And that's going to give you, make you profitable in the long run. Okay, so if you're using the conservative stop loss approach, your stop loss would have been above this previous lower high, because obviously if price was to come all the way here, then the trend that you were assuming in the market would have been nullified. Because if price truly is in a downtrend, then it should have no business whatsoever going to this higher low. This lower high, okay? Because we are in a downtrending market, we're forming lower lows and lower highs. So if for whatever reason price was to come all the way up to this level, then we are no longer in a downtrending market. The trend would have clearly shifted, okay? And you'd see that in a moment, okay? But let's say you are using the aggressive approach. The aggressive approach is your stop loss would be very, very tight, maybe just a couple of pips above the candle you used to enter into the trade. The positive side of this approach is that your stop loss, since your stop loss is very tight, you're going to usually have high reward to risk ratio trades, which means you could risk one and aim for 1:5 or 1:3 or 1:to whatever, and then just a couple of trades that you take would give you very, very big profits. But the downside to it is that your win rate is going to be very low. So you're going to take losses a lot more than somebody who is going to be using the conservative approach. But your profit on the positive side, because your profits on average are much larger, because somebody who is using the conservative approach is usually going to be aiming for maybe 1:1 or 1:2 risk to reward ratio. I usually don't recommend 1:1. 1:2 is fine, okay? Because you could lose more trades than you win if you take a large number of trades and still end up being profitable. But with 1:1, the emphasis is very high on having a high win rate for you to become profitable. But for somebody who is using the aggressive approach, his win rate might just be, mediocre, something like 30%. But because his profits from the winning trades he takes are so large, on average, he's usually maybe even going to have made a lot more profits than somebody who has the conservative approach, who is usually going to even have a higher win rate than him. So you need to pick and choose which one works for you or which one you resonate with more and then go with it. So if you're using the aggressive approach here, you would have, even if you're going for a 1:3 risk to reward ratio, this would have been a clear winning trade. Okay, again, I'm not showing you these examples to make you feel as if you use this trading methodology, you're not going to have losing trades whatsoever, because that's not the case. The truth is, whichever trading methodology you choose to use, you're going to have winning trades just like you're going to have losing trades. You just need to find something that resonates with you, something that you really like and choose to use, and then stick with it. No jumping from one strategy to the other. Okay, so moving on. You can see here, this was a winning trade if you're using the aggressive approach. And if you're using the conservative approach, well, it wouldn't have been quite a winning trade. The reason is because price moved from forming the market structure of a downtrending market to all of a sudden sweeping liquidity and then shifting to making the market structure of an uptrending market. So how did that happen? Look at what happened. Price was forming lower lows and lower highs. Lower lows and lower highs. Lower lows, all of a sudden, price failed to form a lower low. It now formed a higher low. So price would have broken above this resistance, and now for it to form a lower low, it's even struggling. So it was forming equal lows around here. And then now it was just kind of like, bouncing up and down in this area, but it started to form higher highs and higher lows. And this was a clear liquidity sweep. And after this happened, you could see that price now moved from forming the market structure of a downtrending market to now forming the market structure of an uptrending market. We could see it here. So price went from forming lower lows and lower highs to now forming low. This was a higher low, okay, a higher high, higher low, Obviously, this was kind of like a liquidity sweep. And then this was, again, a higher high, higher low. You can see clearly the market structure has shifted. So this would have been your cue to start looking for long trading opportunities. And if this was the case, if you were kind of like a pullback trader, for example, this would have been a very good opportunity for you to take a long trade setup, because after this price broke above this level here, you can see that when it pulled back, in fact, it couldn't pull back all the way in because the trend was just that strong. So this would have been a long trade setup for you. So assuming you took this long trade setup, if you are using the aggressive approach, this would have been your entry above this at the close of this bullish engulfing candlestick, and your stop loss would have been right below the candle, maybe a couple of pips below the candle, and you would have been aiming for maybe a 1:2 or 1:3 risk to reward ratio, whatever the case might be, and this would have been a winning trade. Okay, but if you are using the conservative approach, then your stop loss would have been all the way down here, because this was the most recent higher low, and then you would have still been in this trade, maybe aiming for a 1:2, but you could see, like I told you, the disadvantage of using the conservative approach is that because your stop losses are going to be wider, your profit targets are going to be further away from price action. So it's going to be a little bit harder for price to hit it. So you just need to pick and choose which of these styles resonates more with you, and then back test it out, see for yourself how it works and how you resonate with it, and if it's going to be profitable in the long run, so that you can adopt it and test it and refine it and use it. Okay, so this pretty much brings us to the end of this week's episode of the ITU Forex class. But as usual, before we wrap up the class, I would like to use this opportunity to invite you guys to test out our ITU suite of bots, or expert advisors as they are called, which are designed to help you look for low risk, high probability trading opportunities and place those trades on your behalf with proper risk management, and get you earning while you're learning how to trade. So you could diversify your portfolio to a portion of your portfolio doing automated trading and helping you to earn while you learn, while you're out there doing, if you're a busy person, it will help you and trade on your behalf while you're out there doing what you want to do, or working a regular 9 to 5 job, or whatever the case might be, while you learn how to trade the remaining or other portion of your portfolio using the manual techniques which we teach in the ITU Forex class. So if you're interested in it, please let us know by indicating your interest in the questions in the comment section, or reaching out to us on any of our social handles, and we'll be more than happy to assist you set everything up step by step. Okay, so in the meantime, I would like to again thank you guys for taking time out of your busy schedule to attend this class. I look forward to seeing you guys in next week's edition. God bless you and have a wonderful rest of your week. Cheers.